Welcome to the Federal Retirement Podcast. My name is David Rates from Benchmark Financial Group, and every month we discuss important topics regarding the retirement planning process for federal employees. This Lunch and Learn series is an interactive discussion where individuals can ask questions. To join these discussions live, you may register by joining our email list at bfgkc.com. We also provide in-person retirement planning and benefit education to federal employees. To learn more about these seminars or to schedule a seminar at your federal agency, go to our website at bfgkc.com and click on seminars. Additionally, if you're looking for assistance to get your retirement on the right track, set up an appointment with us today. You can schedule an appointment online by visiting our website at bfgkc.com or email me at david.rates@bfgkc.com. The contact information is also listed in the description. By setting up a complimentary consultation, we can review your financial situation and develop a plan to meet your financial goals. We hope you enjoyed this topic and hope to connect with you soon.
Well, thanks for tuning into today's call, everyone. Like Patty said a second ago, the topic of the day for today is just touching on some ideas on different ways that you can make the most out of that pool of TSP retirement savings. So feel free to chime in with any questions that come to mind and we'll get going. Alrighty. So obviously, when it comes to TSP, um, the amount you contribute into the plan is kind of one of the starting points or one of the bigger variables. So income potential at the end of the day kind of breaks down, or one of the major variables. It depends on how much you and your agency contribute during your working years. So maximizing contributions throughout the course of your working career definitely has a significant impact on the amount of income that's generated out of that pool of savings. Maximizing contributions can put you in a spot where it's not uncommon for folks that have been working for 20 or 30 years to have an income stream generated from TSP that's pretty darn close, or maybe even a little bit more than income that's spinning off your first retirement pension. So keeping that in the back of your mind. And then this one, the last one is important bullet point. Definitely understanding the risk and reward difference between the individual TSP funds. It's not that any of the TSP fund, they're all fantastic funds. It's a matter of familiarizing yourself with what they're designed to do and how they work. So knowing the difference between how G fund works versus C fund, for instance, can have a major impact on the total balance that you accumulate at the point of retirement with TSP savings. So understanding just the difference between how G fund works versus C fund is an important piece of the pie, which leads us into the next slide. I thought it was worthwhile to just take a look at and digging into the weeds here for a second. So G Fund's inception date is April 1987, whereas C Fund is January of 1988. But G Fund's average annual return since inception has been a little over 4.5%, so 4.65%. C Fund's average annual since January 29th of 1988 has been 11.23%. Now, granted, C Fund doesn't grow at a 45-degree angle. Sometimes it's higher and sometimes it's lower. But when you take into account all the years since January of 88, 11.23%, it's a major difference. And granted, you also have to take into consideration oftentimes the closer and closer people get to at least the retirement date, oftentimes they want to be a little bit more conservative with the balance of money that they have in TSP. So it's not uncommon for folks to have a higher proportion of money invested in G, so they have a number to plan based off of. But when you're taking into consideration if you're younger on in your career and you had your money invested in C since like the late 80s versus G, the difference between like 6.5 or technically 6.58% more average annual return just by virtue of where the money was invested has a major difference on the balance that accrues and the income that's generated from that pool of savings as a retiree. So that's an important one to keep in the back of your mind. Just a refresher on matching contribution. So obviously your agency, if you're a FERS employee, automatically you get 1%, but as long as you contribute at least 5%, they're going to match you 5%. So that you definitely want to get at least to a 5% contribution because it's free money independent of what it's doing in the marketplace. So if you're putting in 5, you're getting 5 on the back end for a match. Just keep that one in the back of your mind. And knowing the difference between the different ways that you contribute, whether or not you're contributing on the traditional side or the Roth TSP side. Traditional TSP contributions have been around quite a bit longer than Roth, but Roth it's an important component, especially if you know how to leverage it. So just a refresher on traditional TSP contributions. On the traditional side, those contributions roll in pre-tax. So each dollar that you're putting in to the traditional side of TSP today reduces your current taxable income today. The caveat is you pay ordinary income tax when you take the money out. So that's always a question of, if you need X amount out of the traditional balance, what's the net that you need after you account for federal and potentially state income taxes? On the Roth side of things, you've already paid income tax on the money that you use to fund a Roth. So the caveat is if you wait to certain pinpoints in time, usually waiting until at least age 59 and a half, you can tap into that account and there's not going to be any taxes due on the gain. So Roth is also an important piece of the pie. So keeping just the different tax status of how those accounts are funded is always important. So digging a little bit further into the weeds on the traditional side, obviously, like we said a second ago, it's pre-tax. So each dollar you're putting in it today reduces your current income tax. The withdrawals come out, you pay ordinary income tax at the point that you put the money in your pocket. So taxes are due when the money is withdrawn from either traditional TSP or traditional IRA. So one of the major caveats of traditional TSP or traditional IRA, that pool of money is eventually subject to what's called a required minimum distribution. So, and for a while, it was RMD age was 70 and a half, and then it was 72. And now they've kicked the can down the road a little bit further, and it's age 73. So if you haven't taken any money out of the pre-tax traditional pool of TSP savings, eventually, when you get to currently it's age 73, there's going to be what's called a required minimum distribution that kicks in. And the thing about RMDs is they start off at a certain percentage. So at age 73, it's 3.78%, but then it goes up a little bit each year going forward from there. So obviously, like at age 80, it's just shy of 5%, 85, 6.25%, 90, 8.2%. And it just goes up and up and up from there. But that one creates an interesting scenario where you've always got to keep an eye toward, ideally, you've always got to keep an eye towards a growth component inside of that pool of savings. Because if you're in a spot where you're not growing as much as the automatic withdrawal rate, you're going to be in a zone where you're taking a higher and higher percentage withdrawal out of a balance that's incrementally going down in value. Most of the time, people don't want to be in that boat. So it takes some due diligence to figure out an income strategy with all of these pools of retirement savings over the long haul of retirement. So moving on, just digging into the weeds a little bit more about Roth TSP contributions. Just like we said a second ago, those contributions come in after tax or post tax. You've already paid money on the money that you use that you're using to fund the Roth TSP. One important caveat is the withdrawals are tax free as long as it's been in the plan for 5 years or you're age 59 and a half. Most of the time, people have had the money in the plan by the time 59 and a half rolls around, but that 5-year component is an important one depending on the timing when you fund it. Sometimes as people start to make more, ideally when you're talking about a Roth, you want to fund it when you're in your lower income earning years, have a ton of gain in that account, and then take it all out tax free as a retiree. But sometimes people are trying to build up that balance a little bit more going into the home stretch of retirement. Well, there's nothing wrong with doing it that way. It's just the more money you make with the Roth, you start to lose a little bit of the tax leverage, because most of the time people are in a zone where they're in their higher income earning years towards the tail end of their careers. So, but it's always important to have a balance of Roth money, because having a pool of retirement savings that's not subject to required minimum distribution is an important variable for a lot of folks. So, and like we said, gains are withdrawn tax free, assuming you hit some of those important check boxes of 59 and a half or having it in the plan for at least 5 years. Another important variable here too is there's no income limitations for Roth TSP contributions. In the outside world, if you make certain amounts of money, they start to phase out your ability to contribute to outside Roth IRAs. So in theory, you could put all of your contribution amount into the Roth side of TSP, which just gives you an avenue to contribute noticeably more money inside of the Roth TSP than you can in a outside Roth IRA. And also just another refresher on the fact that the Roth TSP is not subject to required minimum distributions by virtue of the fact that you've already paid taxes on the money that you've used to fund it. So moving on to contribution limits for this year. So the base deferral for this is kind of like the blanket deferral that applies to all ages. Base deferral for combined total of contributions between either all traditional, all Roth, or the combination of the two is 23,500 for 2025. So there's an interesting little caveat to contributions for this year, assuming you fall into one of the specific ages. But if you're age 50 to 59, you're eligible for a catch-up contribution of an additional $7,500. But then this year is where the change took place. Assuming that you're 60, 61, 62, or 63, your catch-up contribution is a little bit higher. If you're in that boat, you can contribute up to 11,250 for an additional catch-up contribution. But then interestingly, from age 64 beyond, the catch-up contribution amount reverts back to that 7,500 number. So just in the back of your mind, if you're 60, 61, 62, or 63, your catch-up contribution is 11,250 versus the 7,500. There's the base catch-up for pretty much everybody is 7,500 this year. But if you're in that zone where you're in 60 to 63, you get a little bit higher amount. So keep that one in the back of your mind too. Just a refresher on individual funds versus life cycle funds. So individual funds, the investment mix is your decision. You decide what the mix is of GFCS or whether or not you want to use any or all of the funds. Life cycle funds are a pie chart of GFCX and CS&I. It's a mix of all 5 of those funds, and it's automatically adjusted on a quarterly basis. And in a nutshell, with the life cycle funds, the closer and closer that you get to the date, the more conservative you get. So the L2030 fund has a larger proportion of money in like G fund and F fund, for instance, as opposed to like the L2075 fund, which we'll touch on here in a second too. Just a reminder of the individual funds themselves. G fund is government securities. That's U.S. Treasury bonds. It's pretty much the safest fund out of all of them. It's not going to go down in value, but it's not necessarily going to blow the socks off of growth to the plus side. F fund it's a bond fund, or technically defined as a fixed income fund, which tracks the Bloomberg U.S. aggregate bond index, kind of like a total bond fund. It's a mix of treasuries and investment grade bonds. C fund is essentially an S&P 500 index fund at the end of the day. C stands for common stocks. S fund oftentimes it's a little bit more variable. Sometimes it has higher highs and lower lows, but that's because S fund specifically targets small to medium size U.S. companies that aren't included in the S&P 500. So the S&P 500 has like 100 mega cap companies and then 400 mid cap stocks. So it doesn't specifically package small cap stocks into it. That's why S fund is a separate fund. And then I is international, which tracks Morgan Stanley Composite EAFE index, Europe, Australia, Far East index. So just a refresher a little bit on so traditionally G fund and F fund would be considered the 2 safer funds. G is U.S. Treasury securities. Principal and interest are guaranteed by Uncle Sam, U.S. government. It's calculated, principal or interest is calculated monthly based off of market yields of all U.S. Treasury securities, and it has the most protection from market variability. F fund, like we said a second ago, it's a fixed income or U.S. bond fund invested in a mix of U.S. government mortgage-backed and corporate bonds, and this one has a tendency to ebb and flow based off of where interest rates are going. So your gain potential kind of ebbs and flows with the direction of interest rates. So if you're in a decreasing interest rate environment, that's usually a better position to be in with F fund than if we're in an increasing interest rate environment. C fund, like we said a second ago, the S&P 500 index, it's a market index made up of a bunch of stocks that are U.S. listed companies. potential to earn higher investment returns over the long haul, but it also obviously has greater variability than like a G or an F fund. An S fund is small companies not included in the S&P. Some companies that aren't big enough to be included in the S&P 500 index. So usually small caps have a market cap between 300 million and 2 billion. So companies kind of in the growth phase with S fund at the end of the day. iFunds International tracks MSCI All World Index, which usually has a little bit heavier focus in China and Hong Kong. It's a broad market index made up of large, medium, and small companies. So you get a mix of everything all across the board with iFund, and it's invested in more than 40 developed and emerging market countries. Geopolitical risk, currency risk is always a factor with iFund. So keep that in the back of your mind. And in terms of life cycle funds for 2025, now they range all the way from L income up to 2075. I think 2075 was one of the new ones this year. They got rid of L 2025. So now L income is technically like the most conservative, but L 2030 would be pretty darn close in terms of its risk allocation. And then 2075 is a little bit more market variability in that fund, but more potential for growth too. So understanding the major difference between life cycle funds is an important component, because sometimes people they'll have like 2 or 3 or 4 different life cycle funds, and that almost puts you in a spot where there's too much splintering going on, because each different life cycle fund has a pie chart of GFCS and I. So if you had money in L 2075 and you had money in L 2045 and L 2030, you'd be diversified, but it's almost like it would be too splintered. So take that into consideration when you're thinking about where the best place to have things invested would be. This one is just a snapshot of fund returns year to date and for each of the 5 main funds. So G funds up about 2.5%, 2.6% to the plus side. F fund, it's 3.76% to the plus side. C funds bounce back from the volatility that we saw on the front end of the year pretty well. 8.56% to the plus side. S fund just shy of 4.7%, and then iFunds had a pretty good run, 16.89% to the plus side with iFund performance year to date or return year to date. But this one, I always try to emphasize to folks, keep in mind that statistic of average annual on C funds since January of 88 has been 11.23%. It doesn't grow at a 45-degree angle, but 11.23% average annual since inception is a pretty good number at the end of the day. So moving on to, eventually people start to shift their focus in terms of a planning of what do I do with this pool of TSP savings that I've been saving all these years. We oftentimes try to emphasize oftentimes people are in a spot where they take one TSP and split it up into 2 or 3 different accounts that are all kind of earmarked to do different things at different times. And an easy way to think about it is usually people are in a zone where they'll have a specific amount invested for a relatively short duration of time. So sometimes that's anywhere from 1 to 5 years. They'll have a long-term bucket that's oftentimes earmarked for income after 65 or 62 or 70, for instance. That's kind of set up to be a source of monthly income, just not immediate monthly income. But one of the important ones that you always have to take into consideration too is having an emergency or opportunity bucket. Big 4 with the emergency opportunity bucket or house, car, medical, vacation fund. So in that sense, you want that pool of savings to grow. So it has to have a growth component to it. But oftentimes people will pad that emergency or opportunity bucket with an amount that they'll have invested in like a short-term bond fund or money market cash. So they have a pool to draw from inside of that account where they don't have to worry about selling stock shares if the timing of their withdrawal overlaps with market volatility at the wrong time. So there's ways to tailor investment strategies to meet kind of the check boxes that you want to have with each bucket. But this would be like a snapshot of a total strategy. So we're looking at right here. Pink box would be a pool of savings that's designed to generate income from age 62 to 65. So 144,000 spits out for planning purposes, 4,000 a month for 36 months to get to age 65. And then on the flip side, the plan would be to turn on income at age 65 from the blue box and start taking 5.4% withdrawals up to 9% withdrawals on a monthly basis, and then have a bucket of money that's set aside, which would be the green box, for emergency or opportunity type of withdrawals. You're making sure you have enough liquid cash that isn't necessarily earmarked for paying out monthly income, but you have easy access to it for emergencies or opportunities that crop up, that's invested in growing. But you can get your fingertips on it easily, but it isn't spitting out like a monthly income payment to you type of a situation. So just a refresher, in this scenario, in this specific or situation, it made sense for this person to put a little over 625,000 into that emergency opportunity bucket. And it doesn't necessarily, I mean, the amounts are different for everybody's individual situation, but the thing you want to keep in the back of your mind is the major purpose of this pool of savings, or this investment pool, is to have a pool to draw from for the big four, which are usually house, car, medical, and vacation type of withdrawals. And we try to do that in a way so if you have everything in one bucket and you take an extra chunk, depending on the amount of the extra chunk, the timing, and the amount that you would have spinning off for monthly income, sometimes you need to adjust those withdrawal rates. So subdividing them just makes life a little bit easier and reduces the margin for error, so that you don't run out of money quicker than you were planning on with certain pools of savings. That's why we subdivide them out. And then this is just a snapshot of the long-term bucket, where usually that one's earmarked for monthly income. It has to have a growth component in terms of how it's invested. And oftentimes people are planning on setting that up for a monthly income payment at specific ages, whether it's 65, 62, 60, 70. So everybody's scenario is a little different. So, and it's not to say it needs to be three buckets, but oftentimes people are in a boat where they want to have a short-term, long-term, and then an emergency opportunity bucket. And then some tips to consider, or things to keep in the back of your mind: having an adequate amount of liquid emergency opportunity cash is important. It doesn't necessarily have to be like pre-tax, like traditional TSP money. Sometimes people just have accumulated savings that they have set aside for their emergency or opportunity bucket. If it's like a pool of after-tax accumulated savings that fills that role for you, then you don't necessarily have to account for TSP money providing that component for you. So that's just an example of everybody's scenarios, just a little unique. Don't make emotional decisions, or if you're in a spot where you were able to sniff out market volatility before it kicked in, that's always ideal. But if you were in a zone where market volatility kicked in and you see your account value going down, you don't want to make emotional decisions or see like a 2008 type of scenario and take your money out of the funds that they're invested in and rush to G fund. If you do that, then oftentimes people put themselves in a spot where they lock in their loss and they're paralyzed trying to figure out when to buy back in. So keeping that in the back of your mind is, don't make an emotional decision that locks in a loss and doesn't provide you an ability to recoup that money, because gain isn't realized until you sell your shares. So knowing that is an important piece of the pie. And then rebalance things. Usually try and keep an eye on doing it on a quarterly basis, but just keeping an eye on where the funds that you're invested in and what's going on in the overall marketplace. And you don't need to freak out about it on a daily basis, but just kind of having a periodic chunk of time, where usually on a quarterly basis is a good time to do it, because that's oftentimes when statements start to roll in. So, and then evaluate other retirement income sources. And you don't want to specifically, when you're planning for retirement income amount, you want to look at all the pieces of the pie. You want to take the TSP income amount into consideration, along with the money that you're getting paid from first pension, the money that you're getting paid from the first supplement or Social Security, and make an informed decision on how much money you want to have spending off of TSP savings. And oftentimes that's figuring out that amount is getting you to a number so that you're as close, or maybe even a little bit higher, in terms of the net monthly that you're used to living on. So taking into consideration all the other pieces of the pie relative to the fact that you have a lot of deductions that you pay for as a retiree that go away at the point of being, or you have a lot of deductions that you pay for you're working full time that go away at the point of being a retiree. That's taking those variables into account is the most effective way to make an informed decision on how much money you'd hypothetically want to have spinning off for monthly income out of TSP savings. just getting a refresher on the different withdrawal options. So you pretty much have four main ones: lump sum payment, partial payment directly to you to like checking account type of a scenario. Sometimes or full or partial rollover to a traditional or Roth IRA is an option for a lot of folks. You can set up specific dollar amount for monthly payments or have a life expectancy payment. Usually people, depending on whether or not they have like a chunk of money that they want to have paid off at the point of retirement, sometimes they'll have a partial payment paid directly to them, or depending on where they're at in terms of the age that they retire relative to 59 and a half. Sometimes it makes sense for people to keep a specific amount of money in TSP for monthly payments, because if you hit that age 55 rule with TSP, you can have that money paid to you for monthly income, not worry about paying that an additional 10% early withdrawal penalty, which touch on here at this slide. So if you hit a checkbox where you retired age 55 with, it used to be 55 with at least 30 years, but now I think it's just age 55, and you had enough time in the plan, you don't have to worry about, you always have to pay federal income tax, potentially some state income tax. Each state's tax laws are slightly different there, but leaving money in TSP and having it distributed on a monthly basis when you can retire on an unreduced pension prior to age 59 and a half puts you in a spot where you don't have to worry about paying an extra 10% early withdrawal penalty. So 10% early withdrawal penalty generally doesn't apply to TSP distributions coming in on a monthly basis after age 55, or if you're a law enforcement or a LEO, ATC folks, or public safety folks. That's that age restriction and gets pushed back to age 50. So if you're like an air traffic controller or LEO that has to retire at 57 type of scenario, you can tap into TSP earlier than that and not have to worry about paying that early with 10% additional early withdrawal penalty. So depending on the timing of when folks retire, sometimes they'll leave a specific amount of money in TSP, have that distributed on a monthly basis so they can get past that age 59 and a half time frame. Life gets a lot easier after 59 and a half in terms of your ease of access to things. But sometimes, depending on when you want to retire from the government relative to all the other stuff, you just have to be strategic about lining up different payment amounts at different times so that you don't accidentally shoot yourself in the foot with early withdrawal penalties in addition to federal and potentially some state income tax. Alrighty, so how do you start the strategy? With us, it's usually about a 3-meeting process. First meeting is what we call the fact-finding meeting, where we send you a list of identifying information to gather. And the more accurate that information is, the more accurate we can be with the stuff that we put together for you in version 1. Version 1 of the plan, we take all that identifying information and give you choices for what to do, like survivor options on your first pension, what to do with a FEGLI insurance as a retiree, a projection of what you're going to get for the first supplement, an income strategy with an investment and income strategy with TSP. One of the big ones is a net monthly income comparison that just takes into account the deductions that you're paying for while you're working full time relative to the deductions that you pay for as a retiree. And oftentimes the net monthly income as a retiree is closer than people think it is, because it's easy to forget about all the deductions that you pay for while you're working full time. And then in subsequent meetings, it's usually a refining process. So sometimes version 1 morphs into version 2 or 3, depending on different adjustments that people want to make. And then it's a process of finalizing what income strategies make the most sense for your individual scenario, and get the process of opening up oftentimes IRA accounts or after-tax brokerage accounts, and then reviewing the plan on an ongoing basis. It doesn't stop. The relationship with our clients doesn't stop after the point of retirement. So oftentimes it's an exercise in setting up an income plan at the point of retirement and then making adjustments to that income plan as life happens. So it's a fluid thing, and it's ongoing from the point of retirement. So what items do you need for the first meeting? Obviously, any sort of HR retirement projections are always helpful. Just a recent copy of a leave and earnings statement is an important one, so we can run that net monthly income comparison. Just a recent copy of the TSP statement, because we like to get an idea of the relative balance in the funds that you're invested in. And then any other investment statements or pools of money that you had earmarked for retirement income, detail on any life or long-term care policies. Social Security statement, divorce decree, and then eventually sometimes people get to the point of wanting to add in spouses benefits too. So if that's a piece of the pie, then go ahead and send those over as well. How about any questions, Patty?
There aren't any questions right now. David?
Thanks for tuning in, everybody. Like you said earlier, if a question comes to mind that we didn't touch on, you can always give me a call, shoot me an email, or just submit your question via the website. Um, thanks for tuning in, and hope to talk to you guys in the near future.